This is Bloomberg Intelligence.
We're really getting into now the streaming's arms race.
Dish is looking at that and saying we can really build a nice niche for ourselves.
In-depth research and data on 2,000 companies and 130 industries.
The dollar is the dominant concept in the planet.
I think the acquisition is a natural progression of what Microsoft can do with this technology going forward.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Over the next hour, we're going to dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we're going to take a look at the impact of energy drinks on the U.S. beverage sector.
Plus, will Microsoft get a boost from AI-based additions?
All right, but first, it was sort of the bank tax that you heard around the world. Italy's banking levy could actually raise more than 2 billion euros as the government is trying to seek some clarification on a ceiling for the tax of about 0.1% of assets. Basically, if you make a lot of money, the government's going to want a piece of it. The question is, how big a piece are they going to get? Joining us now, Bloomberg Intelligence financials analyst Lento Tang. Lento, what are these Italian banks on the hook for right now?
So our calculation is it's roughly 2 billion or so for the 6 Italian banks in our coverage. So that's equivalent to 20 to 30 basis points of common equity tier 1 ratios. This could be easily absorbed by the bank's excess capitals. This should not impact their shareholder remuneration plans. Obviously, this is very much different from what the tax was initially released, and the estimation then was much higher.
So, Lento, give us just a history here of Italian banking. How often is it that the government comes in and levies a tax on some of these banks? And how do investors view this?
So the windfall tax is not a new thing, especially in Europe. So it has been a rumor that there could be a windfall tax in Italy. But the new government, well, it's not so new anymore, but the current government has never been against the bank in the past, so it took the market by surprise.
It did, yeah.
I think, and not just the tax. It's actually, I think it's more the way the tax is communicated really took the market by surprise, because it was first announced on the evening of August 7th by the Deputy Prime Minister, Matteo Salvini, not by the Finance Minister or by the Prime Minister herself. And the initial announcement was very vague on the details. So the market expectation estimate for the tax is between 2 billion and 5 billion, very wide range. And obviously, whenever we have this kind of tax, people wonder, is this going to be a one-off or is it going to be multi-years?
Totally.
So
a multi-year, also is it going to go to other sectors? Like, there's lots of different questions that go around it. My broader point, though, is in this case, do governments want banks to be banks? Because then the banks need the money to then make the loans. So I get really confused as to what banks are supposed to look like. Are they supposed to look like regulated utilities, or are they supposed to look like banks?
Yeah, we've heard a lot of that. I think banks is basically just an easy target at this point, because we have been in negative rates for so long, and suddenly banks are making huge amount of profit, and that's mainly because the lag between the asset repricing versus the funding repricing, and that's natural. However, it is hard to justify this sudden increase of profits when the cost of a living crisis is pinching on households. So banks are an easy target at the moment, but I think the way that the tax is structured is less efficient to pass down this so-called cost to the households. Rather, it's more of a way for the government to raise some taxes.
Lento, talk to us about what the impact is here really on these banks in terms of their ability to return capital to shareholders through dividends and buybacks.
So if the current policy stays as it is and does not extend beyond 2023, we expect the total impact to be quite manageable, the 20 to 30 basis points, as I mentioned earlier. So that would not impact their current shareholder remuneration plans, because their current plan is considered not too ambitious.
What about the big guys like a UniCredit? Are they worse or best off?
Well, they're certainly not better off because it's still a tax on them. However, I could say that some banks are less impacted than the others. For example, like UniCredit, because they have a very big international foothold. So Italy is only less than 50% of their net interest income. And Mediobanca is another example that is less affected because their balance sheet has always been less sensitive to interest rates because all of the hedges in place. So these two banks will be affected less compared with the other Italian peers.
Right, less, not better. I mean, fair enough. Okay, Lento, thanks a lot. Lento Tang, Bloomberg Intelligence financials analyst.
Let's turn now to the performance of specified mortgage-backed securities, which have the potential to improve this year. For more, we're joined by Bloomberg Intelligence MBS strategist Erica Adelberg. Erica, all I know about your business, your market, the mortgage-backed security markets, is the 30-year fixed rate is like 7.3% or something. What is going on in it? Where is it?
It's above 7?
Oh,
yeah.
Well above 7.
What?
All right, so how does that's bad for people? I actually feel smart now with my 6 handle on my Jersey Shore estate. What's that do to your market, the mortgage-backed securities market?
What it does is it just makes people more and more reluctant to take out mortgages, which reduces supply. And it also increases the length of time they'll hold on to their lower coupon mortgages. So some of these mortgages that originated in 2020 and 2021, not only the people never going to probably move or relocate, but also the people who own these 2% coupons are pretty much never going to get their principal back, which when you have a $80 price security, that's actually not a great thing for your valuation.
Literally, you're describing me. Have we talked about this? That I have 2.75% 30-year fix? I do.
Nice.
Like I'm exactly what you're describing. Like
You're
I'm never
moving.
moving. I'm never gonna prepay. I'm gonna stick with that happy place. Even if I get like a boatload of money, I'm just gonna stick it somewhere else and make 5%. Like why would I prepay? So I'm causing a lot of problems for the market.
Yes.
You are, yes, in fact.
And refis too. Like I'm definitely not gonna refi.
Yeah, well, refis are a better thing in a way because if rates really had fallen that much that somehow you'd be in the money, you probably would prepay. But, for people who have more like a 4% coupon, for instance, if rates fall 200 basis points, all of a sudden that 4% coupon might be worth something, and you'd still prefer people wouldn't prepay, refinance that mortgages.
All right, so when you talk to institutional investor clients, where are they putting the money to work in your market?
That's a very good question. There's been, the problem right now is, of course, the Federal Reserve had been buying any excess supply that was around. And while supply is way down, almost all of it now has to go to total return investors because the banks also aren't really buying. So it's interesting when the FDIC liquidation happened, in the course of the past couple of months, kind of to my surprise, that was actually really well received because so many money managers and others that do invest in the mortgage market actually had been frozen out of the market in some ways when the Fed had bought as many bonds as they did and really tightened spreads. So at these wider spreads, they were actually happy to take down a lot of that new to the market, not new issue, new to the market, low coupon supply. But I do see that, probably they're getting a little bit full at this point because dealer balance sheets have gone up also. So that probably means that the dealers have had to take down some of that supply.
You might have already answered this, but this goes to Paul's intro. The specified mortgage-backed securities versus generic. What is that?
Most of the market's just kind of very generic. There's nothing special about it. It's going to prepay kind of like everything else, which is probably the riskiest of the securities out there. So let's say you have a $350,000, $400K loan. You take out a mortgage at 6 to 7%. That's going to be pooled with a lot of other mortgages that look exactly like it. Now, if you're from specific states like New York, you might be less likely to refi quickly because there's a lot of extra taxes involved every time you take out a new mortgage in New York.
Tell me about
or if, for instance, you were lucky enough to only have to take out $125,000 on your mortgage, you're also going to be less likely to refinance because you're not going to save as much when interest rates fall. And at the same time, you might feel less locked in than you do, Alex, for instance, if you have a low coupon mortgage. So as discounts, you might pay a little bit, that loan might pay a little bit faster, or you might get your principal back a little bit better. So people pay up for these few, there's about 7 different specified characteristics that are all thought to offer more value than generics. So I did a little dive because the data is now coming up available on how these have done this year. So far this year as a whole, they haven't added as much value as one might have hoped. But that's partly a function of the environment we're in right now, where the major protection you're buying usually with these is like convexity protection, volatility protection, and refinancing protection, call protection. And, we're in a deep discount environment, and if anything, volatility's been falling a little bit. So the specified pools as a whole have not added that much value, but there's a lot of pockets that have. And the spreads that you can get on an option-adjusted or risk-adjusted basis on the specified pools still suggest that they probably do offer some volatility and convexity protection overall. So still always worth looking at, but maybe not quite the performance that some had hoped who might have paid extra for these special characteristics.
All right, Erica, thanks a lot. Erica Adelberg joining us, Bloomberg Intelligence mortgage-backed security strategist.
Coming up on the program, we'll get the latest on Microsoft's incorporation of AI.
You are listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence through BI Go on the terminal. I'm Alex Steele.
And I'm Paul Sweeney, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us Saturdays at noon Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
Microsoft has been at the forefront of adding AI-enabled copilots across most of its portfolio. This move could add around $5 billion in the first 12 months after the products are widely available for use. For more, we're joined by Bloomberg Intelligence senior technology analyst Anurag Rana. Anurag, the Microsoft story, Microsoft has been quoted to me because I don't know a lot about this whole cloud thing, and they're just like, just shut up and buy Microsoft. Talk to us about how AI and to what degree AI figures into the whole product and service suite of Microsoft.
So when we look at AI or generative AI, I think, when you look at the entire software space, Microsoft is right in the middle of it. There is no one better positioned currently than Microsoft, only because of their relationship with OpenAI, the investments they made a few years ago, and all the buzz around ChatGPT. So they're taking those large language models, they're embedding a lot of those capabilities into their product portfolio. So whether it's Office or Bing or there's a product called GitHub, so it's all over the place, and that's where we they've already launched these products, most of these products in beta testing. It'll be available for general use very soon. So they are faster than any other competitor out there to embed these features into their portfolio.
How are they doing it so fast?
Because of the relationship they have with OpenAI that they have been working for the last several years. So they also just invested another, I think, what was it, $10 billion or so into the company. So that's think about that they're outsourcing a lot of the R&D to OpenAI and using their algorithms to power that. So whether it's their Office suite, which is everything from Word to Excel to PowerPoint. It can do a lot of cool stuff if you want to sit down and say, and you get an email and the email is written for you and reply it, or you want to write some essay, you want to create a marketing presentation. It can be done pretty quickly using these copilots.
So, Anurag, I'm looking at the FA function on the Bloomberg terminal for Microsoft and just looking at the consensus revenue forecast. And, for their fiscal 24 ending in June 24, 11% growth, 25, 13% growth, 26, 14% growth. How much of that kind of growth is coming from, kind of incremental AI expenditures?
I don't think people have modeled anything. And frankly speaking, I think I would say that, our number of $5 billion is very much on the lower side of it, because the biggest beneficiary of AI is going to be Azure, which is their cloud infrastructure product. Now, we don't see those benefits right now because we haven't even reached the point where workloads are going to get there. We are still, going through a phase where enterprises are cutting back on some of the spending. So once we get through that and you can get a lot more workloads, I think Azure growth will accelerate again. Office, generates over $50 billion in revenue, or somewhere around $50 billion. And to just say that they're going to get increment $3 billion out of it is what we are saying right now, but that's only in the first 12 months. Once people really get the flavor of this thing, the adoption rate is going to be higher, and I think the number is going to be much bigger than that after
That's
that.
really seriously law of large numbers that keep getting larger. That's quite impressive. Is that baked into the stock as of yet?
See, that's a very difficult thing to say because a lot of what's happening to the tech space is driven actually by the 10-year and rising rates. It is very little to do with the fundamentals of the company because, frankly speaking, the stock went from 30 times earnings to 17 times earnings, now back to 25 times earnings. So it hovers all over the place where the fundamentals actually don't change for the company as much.
What does Microsoft do? This is a question I ask you all the time on Apple, but I'll ask it on Microsoft. They are $30-40 billion in net cash on their balance sheet, $60 to $70 billion to $80 billion of free cash flow each year over the next few years. Yet they pay a dividend yield less than 1%. So is it the same argument for Apple that they're just not going to up their dividend?
Well, they're going to spend some money buying Activision, so
good point.
That's about 70-80 billion or something. That goes there. The buybacks don't have a big, they don't big factor. It's not a big factor for Microsoft. It's about $5 billion a quarter or so. I don't, exactly the number, but it's not as big as Apple. In the case of Microsoft, I think they do have a a balanced portfolio of acquisitions and debt and dividend and buyback. But I think it's going to be very tough for them to buy anything right now, M&A wise, anything big. I think they're going to start buying smaller companies in the areas of AI, security, cloud infrastructure. Anywhere they can improve their current offering is where I think the most of the excess cash is going to go.
Competitors in this space right now, who would it be? Who do they watch out for?
Oh, the cloud infrastructure, it's AWS. AWS is much bigger, much stronger when it comes to cloud-native workloads, which is if you are a startup, you're most likely going to go to AWS to build your application. The real benefit for Microsoft is that it is really entrenched in the older companies or corporations, as I say, that are non-cloud bound. So the likes of JP Morgan, Citicorp, Coca-Cola. When those companies upgrade their IT infrastructure, they're more likely to choose Microsoft because they've been working with their products for several years, and it's an easier transition to move those applications and workloads compared to Amazon or Google.
So, Anurag, Matt Miller's the only person on the planet that I know that uses Bing, and he raves about it.
He does not.
He does.
What?
He's into this. He thinks this whole chat GPT, whatever it is just the greatest thing in the world. Is Bing... I mean, talk to us about that. What's the company say about that business? I used it the day it was launched, and I haven't used it since.
That makes the two of us at least at that point, and I have been trying to figure out that as well myself. But to be very frank, I've never saw Microsoft CEO this excited about a product in the last 7-8 years. So I'm not going to completely discount it. The AI aspect of ChatGPT and integration with Bing is a good factor, and Microsoft has. Google has 90%, close to 90% market share of the search market, and Microsoft has said, even if I can get 1 percentage point of that, that's $2 billion of extra revenue for me. So the market is, it's truly, honestly, even if they gain a handful of the market share over the next few years, that's just pure gravy for Microsoft.
Mm-hmm. I mean, it's really hard to not see a bullish case. So can you give me the bear side?
It's usually valuations is what I would say is a very important factor. The bearish case is a very simple way to look at it. Microsoft for the last several years has been growing revenue north of 15%. So let's say somewhere around 15%. We have seen unbelievable margin expansion along with it, with them cutting back on sales and marketing, which means the rate of growth of earnings has been north of 20%. It's going to be very difficult for them to do that going forward for the next 3 to 5 years because that margin expansion story is coming to an end. These AI workloads bring in a lot of cost with them. They've already cut their sales and marketing down to like 10% of revenue. I don't think they can really go much lower than that. So if you're growing revenue, let's say, as Paul said, somewhere between 11 and 13% for the next 3 to 5 years, your earnings growth not going to be more than 15%. And then if that's the case, why am I paying 25 or 30 multiple for a stock?
And Alex, just following up on your point, if you go to the ANR function for Microsoft on the Bloomberg terminal, 53 buys,
Jeez.
6 holds, and 1 sell. So there's a couple things there. Do we need 60 analysts following a stock? Yeah, it's Microsoft, but do I need 60 analysts following it? So
that's quite a lot.
Yeah, that kind of shows you
what's up with that 1 sell guy?
Yeah, it's interesting, and it's not some kind of a crazy person. It's Guggenheim Partners, so it's a real shop. So Anurag, all right, Microsoft, NVIDIA. I'm overweight both of those in my portfolio. If I had room for a third AI play, what would it be?
Oh, I think you can't discount Google. I mean, it's just, frankly speaking, Google or Amazon. I mean, they are in the long run, they are really, really key to the AI story. Now, Google, people really are, not being fair to them, in my opinion, but I mean, they know large language model and AI-related stuff better than anybody out there. They're a little behind, but I think they'll catch up.
But there's no AI play for Apple, is there?
It's part of the portfolio. It's a very funny thing. The next iteration of your iOS, when Alex gives you a call, your phone will do a live transcription of it. When you ask Siri some questions, the smartness that goes behind it is a lot of what's AI play that's embedded in the product. Frankly speaking, most of the products, the software products across the entire gamut, will have more and more embedded intelligence in there because of what we are discussing.
All right. Anurag Rana, Senior Technology Analyst for Bloomberg Intelligence, giving us some smart talk on AI.
All right, let's kind of stay with the theme. Coming up on the program, we're going to see how Arista's AI cloud engine is shaping up.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alex Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch the program Saturdays at noon Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We'll be here each and every week at this time, tapping into our Bloomberg Intelligence analysts covering some 2,000 companies and 130 industries worldwide.
All right, so if you're taking a look at AI and sort of the battle for AI and what some derivative plays are, one might be Arista. It's reaping the early benefits of cloud's rapidly expanding AI wars, resulting in a sizable increase to sales and EPS for 2023 to 2024. Want to dig deeper into that with Bloomberg Intelligence Senior Hardware and Networking Analyst Woo Jin Ho. Woo, what is Arista? Can we just start there?
Sure. Arista is a leading networking company that supply high-speed networking gear for the cloud providers as well as the enterprise. Roughly 40% of their revenues go to come from Microsoft and Meta.
All right. So in that tech stack, kind of where are they? What's the kind of the sauce they bring to the table, and why do you think they're well positioned for AI?
Yeah, so if you think about cloud networks in general, they need a lot of high-speed networks. Arista offers that kind of performance. That's why Meta and Microsoft are using them for their hyperscale clouds. Now, in terms of AI networks, you actually need lower latency, high reliability, and high throughput, right? Now, that market has essentially been locked up by NVIDIA, and quite frankly, I think it's going to be locked up by NVIDIA for a couple of years. But Arista is actually making some inroads because there are going to be some technology changes that Arista can take advantage of in AI networks in general.
Like what?
Well, if you think about NVIDIA, right, NVIDIA is actually selling their whole AI cluster, server, and networks and GPUs as just one turnkey bundle. The technology that they use, and I'm going to get a little geeky here, is called InfiniBand. And InfiniBand is something that the U.S. government uses and the higher education use for doing supercompute type of capabilities, right? They need low latency and as well as high reliability. The prevailing networking technology, geeky again, is Ethernet. About 90% of networks are powered by Ethernet, and the clouds have not used Ethernet technology because there's some error correction technologies. But that's going to change over the next couple of years, and Arista is poised to benefit because of their leading positioning in Ethernet within the cloud.
All right, I'm looking at your financial model in your research report, and I see double-digit revenue growth, and I see, operating profit margins in the low 40s. Talk to us about what gives you those kinds of numbers, or what's the model that kind of drives those kinds of numbers for Arista?
Yeah, so look, a lot of it is AI-driven, right? So if I think about where the growth is coming from, it's actually going to be the AI networking piece. The way I'm forecasting out the AI networking piece itself, that Ethernet market, and this is very important here, is growing at a 67% CAGR over the next 5 years, from 2022 to 2027.
Wow.
And it's actually going to be roughly tripling in 2023, and then almost growing 80% in 2024. So what I'm thinking here is that if Arista can continue to drive that momentum and even sustaining that market share, they can easily sustain at least low teens growth in the cloud market. That's driving the top line. In terms of operating margin, it's a very, very scalable model, right? They have about 60% gross margin, and then there's a very little sales motion in terms of selling to the cloud. The more boxes you sell, the more leverage you're getting in the operating model. And that's how I'm getting to my low 40% operating margin.
So is that in the stock price? And that I feel like a lot of the AI names are now a true show me story after they all got dragged up with NVIDIA.
And I'll tell you, Arista was one of those show me stories. And when we started to see some of those show me stories fall and fail and not really deliver on the AI story, you started to see all those stocks start to drop off. Arista was one of those, and then they delivered on the earnings, and that's why we started to see the stock improve about 10 to 15% post earnings. Now, I don't think all of that AI has been baked in. In our scenario analysis, we're above consensus by about 3% on the sales front for each of the next 3 years, and then because of the operating leverage, we're up about 6 to 7% on EPS over the next 2 to 3 years. That being said, I still think there might be scope for more upside if the AI engine really starts boosting up, because Arista is well positioned, other than any other networking company aside from NVIDIA in this space.
That's interesting.
So are cloud expenditures from corporate America, to what extent, if any, are they being cut these days in anticipation, again, of a slowdown in the economy?
We are starting to see some cloud optimization projects, right? So, if I can glean towards some of the software companies as well as some of the hardware companies, projects that are multi-cloud or tied to the cloud, they're actually being scaled back, and we're seeing spending in that area pared back. One of the things that we are starting to see, if we look at cloud CapEx, however, that CapEx number really hasn't changed that much. The balance of the CapEx has shifted more towards AI and less towards the general compute. Just circling back to Arista, Arista has tilted their products more towards the high speed and AI side, offsetting that general compute side.
Is there another? So I feel like a few years ago, all we would talk about would be the cloud and how awesome it is. And now it's about AI and how awesome it is. Is there like the third thing of how new and how awesome it is? Or is it going to actually stay AI while the CapEx gets drained from cloud to AI?
Well, near term, it's AI. I think the next buzzword is going to be multi-cloud, and I'm going to tout my space a little bit more here. As we have different areas of compute, we're using multiple clouds as well as your own data centers. You're going to see companies like HP Enterprise, Dell, Nutanix, all into the mix of this multi-cloud narrative.
All right. Thanks so much. Really appreciate it. Woo Jin Ho, a Bloomberg Intelligence senior hardware and networking analyst. All right, let's turn now to the U.S. beverage space. You got energy drinks have been powering, get that, major moves. Joining us now, Bloomberg Intelligence senior beverages, tobacco, and cannabis analyst Ken Shea. He literally covers anything that you eat in your drink, like he covers it. Okay, beverage space, how they do in Q2 earnings, what drove it?
Yeah, that's right. I mean, this was a really good quarter for the U.S. beverage companies. Going in, we knew it was going to be pretty good. They'd taken a lot of price increases, and demand was still holding up despite, a lot of doom and gloom about the economy and so on. When the dust settled last week, and I looked at the earnings surprises, they beat on revenue, EBITDA, EPS by much more than usual. And even from an absolute point of view, I look at the largest 15 U.S. Public companies, and on median basis, the sales are up about 6%, EPS 11%. That is not bad. It's fact above trend. And so I think what's going to happen here the second half, they'll have a lot of positive momentum. And there's a lot of factors, behind the positive surprise. But let's not ignore something that companies didn't even mention. That's good weather. This is a really good weather. It's hard to read the papers without seeing, hot record levels and this and that.
Oh, wait,
But
so now
execution,
it's hot,
also
so we're
good
going to
weather.
drink more? Is that what's happening?
I think it's been a contributing factor.
Huh.
Now, what the companies are citing is that, there's an easing level of costs. Their aluminum is coming down, aluminum cans, corn-based sweeteners, green coffee beans are coming down. The supply chain is strengthening, like in other industries. You're hearing about, more normalized mechanics about getting goods to the retailer. Labor shortages are easing up a little bit. So all those positive things are helping the beverage companies. And I see a second half that seems to be probably going to come in better than I would have seen a month ago.
What's the outlook for the second half of the year? Like, what kind of guidance did you hear from some of these companies? Because as you mentioned at the beginning, there is concern about this, much discussed recession and impact on the consumer. What are they seeing?
I think there's a lot of caution, Paul. Now, some of this could be sandbagging. You were an analyst. You remember,
Sure.
companies don't want to get too excited and raise the bar. It's much easier to hop over a low one. But I think that, to their credit, there's still some economists out there that are seeing, a recession in the second half. So they're not going to get too excited here. They know they're lapping positive pricing. A lot of the big price increases went in second half of last year. So they're going to benefit in the third, to a lesser extent in the fourth. But after that, as things normalize, then it's back to the blocking and tackling of getting volume out the door. A lot of these the revenue increases are coming from price increases as opposed to volumes. At some point, things that need to normalize again, and that's what 2024 is shaping up to be, more of a balance between pricing and volumes. So for the second half of this year, it's looking good.
Like, which guys are doing well, which guys are not?
From a sales point of view, it's hard to ignore the energy space. Celsius Holdings had a blowout quarter. PepsiCo's energy drinks are doing well. Monster Energy, which Coke owns a piece of, had a really, really strong quarter. That seems to be the best space right now. A lot of it is being fueled by a lot of underserved areas outside the U.S., but even in the U.S., it's a category that's very vibrant. To a lesser extent, good old-fashioned carbonates, colas. It's been around a long time, but it's had a really good year. People are turning back to colas. Price increases are sticking. The mini cans have been a big hit. The leaders credit Coke, Pepsi, Keurig Dr. Pepper. They're bringing a lot of excitement to the soft drink business again. A lot of new flavors, a lot of new packaging sizes, and a lot of promotion. A lot of these companies are taking a lot of the cost savings that I mentioned before and rolling it right into new products, new promotions. They're advertising more because people are out and about in the stadiums. They're going to go to concerts again, and the companies are marketing heavily to remind them that they're there for them and to serve them.
So that's a good news. Talk to us about this story that's fascinating to me, which is Bud Light and what's happened there with the controversy. Just explain kind of what happened and what the impact was on Bud Light.
Well, Bud Light had a promotion. This is a struggling brand prior to the ad campaign that didn't seem to work out for them too well. Been losing market share steadily in the U.S., just a lot of competition in the low alcohol beer space. And they decided to embark on an advertising campaign that was pretty much inclusive to everyone. And part of that was the ad for, transgender person. And, the backlash was much more than they expected. There's signs that the share losses for Bud Light are easing. But again, I think it's a brand that needs to either double down on its advertising campaign, or in the near term, it may continue to struggle based on some of the scanner data that we're seeing.
When we take a look at that, if we just take, say, the beer guys, for example, we kind of hit the energy guys, the beer guys, obviously the Bud Light situation is idiosyncratic, but overall, what's going to drive it? Margin improvement or top line growth?
Well, if I look at a company that's pretty much symbolic of what's going on, it's got to be Monster Beverage. They've expanded a little bit into the alcoholic beverage lane, and there's been a blending. That's another topic of conversation we'd have at some point, the blending of the alcoholic and non-alcoholic lanes. But they pretty much stick to the knitting in energy, and over the last few quarters prior to Q2, they had been suffering, the margins have been suffering from higher aluminum costs, the supply chain disruptions that I mentioned before, to a lesser extent, also negative currency. Companies with big exposure outside the U.S. are getting clobbered, by a strong dollar. And that seemed to reverse quite a bit here in the second quarter. They're lapping a quarter where costs are notably less than they were a year ago. And so if those things were just extended the second half, those things alone, we're looking at a pretty good quarter. One other thing I may mention, Alex, is that a lot of things that I mentioned here that are benefiting these guys are macro and so on. There's a lot of execution needs to be mentioned here as a reason for the favorable performance also. Again, I'm not going to be pat these guys in the back too much. I don't have a practice of doing that, but I think they do deserve credit in some challenging times over the last year. Got to remember, the pandemic didn't affect many industries more than this one. When people are home, they're not out at bars, they're not at stadiums and so on. They found a way to come up with different packaging sizes, promotions, B2B, digital business models, and so on to get through that tough time. And now that they're emerging from it, the changes they made are benefiting them right now.
Hey, Ken, love talking to you. Thank you so much, Ken Shea, Bloomberg Intelligence Senior Beverages, Tobacco, and Cannabis Analyst.
That's this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
And remember, you can access Bloomberg Intelligence through BI Go on the terminal. I'm Alex Steele.
And I'm Paul Sweeney. Stay with us. Today's top stories and global business headlines are coming up right now.